move on to tax season. I do want to just make a little disclaimer here that none of us on this panel are financial planners, and so this is just informational purposes only. And if you need more specifics, you should contact professionals that specialize in this. I'm going to present this tonight. However, I do want to give credit where credit is due. And a lot of this data that I'm going to bring to you tonight was actually created by Aisha. And she is our accountant at Management One, and she heads up our accounting department. So with that, let's get rolling. So the first that we're going to talk about is mortgage interest. Mortgage interest is actually tax deductible for your rental property because it's a business. Most of us don't think of our rental properties as a business, but they are. And sometime in January or February, you'll be receiving a 1098 from your mortgage lender showing the interest that you paid for this year, or last year, I should say. And when you file your taxes, in most cases, you take the deduction on a Schedule E, which is for residential property owners. Depreciation. Now, I actually found this very interesting when I was reading through her stuff, but many people think of their homes as investments that become more valuable over time, but a rental property actually can depreciate just like a desk or a forklift or something like that. Many business assets depreciate every year until they reach the end of their lives. On a rental property, it's actually 27.5 years. And then you can most likely deduct your depreciation each year on your taxes if you own a rental. There are a few ways to calculate that on a rental property. And so that's why we recommend that you speak to a professional who can help you figure that out. I know we had a question come up that's asking, how do we depreciate, or can we, your whole unit, Ron? So land, structure, how does that work? Can you expand on that a little bit?
Well, basically, if you buy a property for $300,000, some people think you take that and divide it by 27.5 years, so you can write it off $11,000 a year off on your income taxes. That's not tax savings, that's just a write-off. But that's not accurate either, because IRS does not allow you to depreciate the land, okay, only the structure, okay? And so basically, if you got $300,000, you basically would take 75,000 of that for the land, because normally they figure about 25% is for the land and the 75% is the structure. So you actually write 225,000 off over 27.5 years. Where it gets a little confusing to people, they go, wait a minute, I'm living in my house and now, okay, that I own, and now I'm going to go ahead and buy another house and make it a rental property. So when I make it a rental property, I can depreciate it. But if I'm living there myself, I can't depreciate it. Yeah. Very confusing, right? Yeah. But it's fact, okay? Because when you make it a rental property, it becomes a business entity, okay? It's not personal anymore. So I know it doesn't make any sense, but just to explain that a little bit.
Great, thank you for that. Also on property taxes, so we all pay them, right, on our personal or our rental properties. And so the tax amount is based on where the property is, how much it's worth. And you can usually deduct your property taxes on a rental property. And what we've found is that most rental property owners, they don't write that off. So again, working with a pro to help you get the most deductions and benefit you is the way to go. Repairs. This is what we hear about the most in our business, right? It's always a repair. So whether it's from broken garbage disposal, light bulbs, patching holes in the wall, there are certain things you can deduct, certain things you can't. And sometimes it's not an actual deduction, it gets capitalized into your property. Something like that would be if you bought a $300,000 rental property and you wanted to add a fourth bedroom, that may not count as your standard deductible. It may get added to the base of your home. Ron, do you want to expand on this a little bit, how that works?
Well, yeah, if you're rehabbing your house, and let's say part of that rehab entails cleaning up the yard, cleaning the house, painting a few walls, then you can write that off in that given year. Okay. But if you're going to install, let's say, a whole new kitchen for $35,000 or something, or put in a new back patio, then they're going to go ahead and capitalize that and write it off over a number of years. It doesn't necessarily have to be over 27 and a half, depending on the situation. Sometimes it can be written off over 7 years, but that's where the CPAs come into play.
And then what we also have seen in just our conversations with landlords is they tend to misclassify their repair costs, kind of like what Ron was just explaining. You have your standard repairs, your garbage disposals, and then you have your capital improvements. The IRS doesn't like us to misclassify things. Other things that you might be able to deduct in a rental property, transportation expenses, if you have to collect the rent, but if you have a property management company, we do that for you. Managing your rental, so your management fees can be a tax deduction or a portion of them. Insurance on the property, utilities. That's it. Those are the top 5. We just, again, wanted to give a broad explanation on those and nothing too deep because we are not professionals, but these are just things that have come up.